and now a red stock market. So today I wanted to get us all up to date as far as what's going on. We're going to keep learning together. I do these videos regularly, so come back, join me, and let's get into it. So yesterday it all started with Israel attacking Iran, and leading into today there were more attacks launched against Iran. Some people were killed, including the head of the Islamic Revolutionary Guard Corps, two general agents, a nuclear facility was hit, and what Trump had to say about it is that he was aware this was going to happen and urged Iran to make a deal before there was nothing left. He also mentioned that that Israel had access to lethal military equipment manufactured by the US and they know how to use it. So it's not looking very good. And what ended up happening out of this mess is that eventually Iran wanted to strike back. They sent 100 drones at Israel. They were shot down in transit. Then they shot some missiles and they eventually struck a spot called Tel Aviv. And I pulled this spot up on the map just to see where it's at, and it's right there on the coastline. And there were some details that I found about Tel Aviv. So Tel Aviv houses about 170,000 people in this center spot of Tel Aviv. The larger Tel Aviv area has about a population of 2.75 million, around 44% of Israel's population. So this is an important spot, even economically. It's Israel's financial and high-tech core. About 40% of all national banking and 11% of Israeli jobs are located in this city. They also have the Tel Aviv Stock Exchange, and it's compared globally to Silicon Valley. So this is an important spot that it hit, and it's not looking good. We also heard from a senior Israeli official saying that Israel planned 14 days of this operation. The defense minister of Israel told us that they decided on Monday to attack Friday. So that's probably how Trump got the news back. So with today them striking back, technically that's war. So stay tuned. We're going to keep watching this. And what ended up happening out of it is that we seen oil spike. We seen stocks pretty much collapse. They did open up pretty positively, but then they sold off into the day. I'd imagine that's because the conflict continued. We seen the VIX open up and it jumped. So bonds sold off, and there's really this uncertainty due to the greater risk of inflation, pretty much to sum it all up, as a result of these attacks. And it all goes back to oil spiking. So just to point out, we seen gold really rally. We seen the dollar kind of rally, although it sold off a little bit into the day. And I thought this was interesting. The Bitcoin chart and the US dollar chart kind of moved similarly today with that slight run up and then sell off. So I just thought that was interesting. Bonds, they sell these bonds anytime they could get. Anytime that chart goes up, they go down. People like holding the bag. But it's surprising that stocks weren't down a lot more, just considering all the mess going on, even with the VIX jumping as much as it did, although it kind of stabilized throughout the day. And I think what's driving this market right now is still that buy the dip mentality from retail out in markets. Bank of America agrees that usually times like this, where there's a lot of uncertainty regarding war, are times for buying opportunities. It doesn't last long, and the International Monetary Fund pointed out that after a month of stocks being hurt from geopolitical risks and conflict and events like this, they usually lead positive after about a month. So they all say this is pretty temporary, so to say. But I mean, this is still messy. Even assuming the US military doesn't get included, we're still indirectly impacted, and it goes back to watching the price of oil, because the price of oil like that impacts so many different things. So Israel's attack on Iran had sparked a conflict that is rattling the oil market as investors weigh the potential. And this article is called How the Israel-Iran War Could Play Out for Oil by Avi Salzman. And they go through and ask a couple questions that get answered, and we'll go through it together. So what are Iran and Israel's role in the oil market? Iran produces 3.2 million barrels of oil a day and exports between 1.5 and 2 million barrels of it. This is a significant piece of the 103 barrels of global oil production, but not enough to completely disrupt the market. Israel isn't a major player, historically pumping less than 10,000 barrels per day, but it does produce some natural gas. How could Israel disrupt the market? Israel could hit Kark Island in the Persian Gulf, which houses much of Iran's oil export infrastructure, though the U.S. would likely stop that from happening, an action that is unlikely to gain favor with the U.S. administration, which would be wary of disrupting oil markets, JP Morgan strategist Natasha Kaneva wrote on Friday. How could Iran disrupt the broader oil market? Iran has plenty of ways to respond. It and its military group it supports, including the Houthis in Yemen, could create much wider disarray in the oil market. And they pretty much just go on to say that Iran and its proxies could block the Strait of Hormuz, a narrow waterway that connects the Persian Gulf to the Gulf of Oman, and from there offers access to markets all over the world. China, which buys buys more of Iran's oil than any other country, is particularly dependent on supplies that come through the strait. So all of this is just sounding messy. Brent crude futures went as high as $78.5 dollars per barrel, which was the highest in January. Iran plays an important role in oil production. We've just seen this, and this conflict may, like, we're worried that this causes inflation. Inflation's the boogeyman, right? And this inflation would be caused through higher energy costs, causing inflation. And think about all of the different things that oil plays in. Like, it goes a lot deeper than you think. Oil's literally everything. So energy costs could jump, airlines would be impacted, trucking companies, which increase your delivery fees on goods produced, utility bills go up on oil dependent regions, everything shipped by truck, flown by plane, moved by ship. Oil spike equals higher logistics costs, and then that impacts your groceries, your Amazon packages, your construction materials. So it all gets more expensive and or even delayed. Supply chains could get squeezed just because the blocks that could happen out of that. Fuel costs surge, warehouse delay shipments, retailers raise prices, manufacturers slow down production. It's a complete mess. On top of everything else that happened, on top of the higher tariffs that can also become an issue if these countries start picking sides. And we aren't even talking about the U.S. military playing sides in the war yet, which would cause quite the scare if we got involved in, like World War III. That's what everybody's like scared of happening. So these higher costs means less left over for spending from both these businesses, which we watch in stocks, and then these consumers. Some of the industries that could benefit from this are primarily your defensives, your energy companies. Think about utilities. Some electrical companies are doing pretty well, solar companies. Some industries to look out for would be like your travel related, your food related, as far as dining out. So hotels, airplanes, cruise lines, restaurants. A lot of those could be impacted by that. Now we've seen I got United States Brent oil up, and I also got WTI offshore up. And I just kind of wanted the scoop as to the main differences between these, and this is what I found. So the primary difference between Brent and WTI, which is West Texas Intermediate, is what that stands for. So it lies in the geographic location and their market influence. So Brent is a blend of crude oils from the North Sea, primarily traded in Europe, Africa, and parts of Asia, and serves as a global benchmark. Let's go back and look at Brent. So we see Brent's up 6.77% today. So this is like your global benchmark, and it's pretty much straight up. Now, what about WTI? Where are we at? So WTI is a light, sweet crude oil produced in the United States, primarily in Texas, Oklahoma, that's where I'm at, and North Dakota, and acts as a benchmark for oil pricing within North America. So interesting. And with this one being smaller, usually smaller stuff has larger moves. and this one was up 10.82% today. So quite the moves like what we seen. Now, this is all a mess. Everybody's uncertain now. Like, we got to add the ER on the back of this one. And that's exactly why we seen stocks perform and markets perform the way they did today. People selling out of these riskier assets, including bonds, and flocking to gold, a little bit into Bitcoin, a little into the dollar, and some of these energy companies, utility companies, solar companies, some of these hedges against this stuff. We got some data that's a little bit out of date now, and it's from the University of Michigan as far as survey of consumers, and it improved for the first time in 6 months is what we've seen. Climbing 16% from last month, but still remaining 20% below December 2024. So what we've seen is that in June, we came in at 60.5, beating the 54 expected. That's up a good amount, but like I said, that's a good amount from last month, up 6%, 16%, but we're still below levels of December 2024 by about 20%. So that's not looking good. Consumers expect 5.1% inflation in the next 12 months, which is down 6.6% in May, and that was looking good. Like, expectations for inflation's down, like that's a good thing. But I'd imagine this conflict in the Middle East raises inflation expectations because of what we were just talking about, oil prices. So caution has been exercised, and I'd imagine it's even more so now. Now, talking about inflation, because inflation is the main topic, this is what the Fed said they're watching, even more than the job market. Many were expecting tariffs to start showing up in inflation reports, including CPI and PPI, that wholesale one, the wholesale data, and CPI is consumer inflation data. So the inflation reports haven't really showed the impact of tariffs yet, but it will, is what some persist to say. Stephen Stanley, a chief economist at Santander Capital Markets, I might have said that wrong, and one of Wall Street's top inflation forecasts, had to say, you can run, but you can't hide, talking about the inflation that is expected to rise from the tariffs, so the tariff impact. And companies really stocked up before the tariffs hit, so they front ran those tariffs and really been sitting on that inventory for a while, which has allowed them to not have to raise prices yet. But as that gets bought up and the inventory begins to deplete, we can begin to see price pressures for the inflation regarding these tariffs to start happening and slipping through the cracks. And it's a tough scenario if you think about it, because raising prices directly impacts demand. Think about supply and demand. You raise the cost of something, demand goes down. And what we have right now, before they even begin raising costs, is that inflation was a problem in the past. So prices are still high and people are still trying to get used to them. So assuming they raise costs even more, demand's already soft. So that wouldn't really help demand, and companies' earnings could be impacted. But if companies don't raise costs, if their costs go up and they just sell it to consumers and the businesses absorb the extra costs instead of consumers, then that'll also impact company earnings. Now, they could do a mix of this, and the businesses could pay a little bit, the consumers could pay a little bit, and they could share these extra costs. But pretty much either way, we're expecting earnings to be impacted, and earnings expectations are already super high right now. And that is really what the stock market reaching new all-time highs is built off of. I believe the earnings expectations for the S&P 500 was like 285 or 280 a share. Now, who knows if that happens? Let's pull it up. So this top one's S&P 500. This middle one is the NASDAQ 100. Oh, these charts look weird when they're sideways like this. And as you can see, this bottom one's TLT. This one's in the mud. So let's get let's get this one off the chart, off the screen. So with the earnings expectations, the highest they've been, all of the uncertainty, all of the you can't really say volatility until today because the volatility index has been pretty low for the S&P. But high earnings expectations, tariff negotiations going up, inflation expectations being high, high interest rates, a possible recession occurring, slowing consumer spending. Consumer sentiment was down, although it's looking a little bit better. In the face of all of this, does a stock market deserve new all time highs? And I'd imagine the general consensus is probably not. And that goes into this survey that we got from Interactive Brokers Advisor Insight Survey, June 2025. And what this survey looks at is they survey financial advisors and their firms. It was conducted April 2025, completed by 113 financial advisors with an average of 19 years of experience, and the firms with an average of 120.2 million assets under management, so AUM. And what we found out from this survey is that they're losing confidence in the US equities and are reloading up on assets abroad, so overseas. They're doing that sell America, buy foreign countries trade. I forget what they call sell America, the sell America trade, I guess. Now, here's the executive summary. Advisors' U.S. market outlook is tepid at best. 36% call themselves bears, while 31% are bulls. Advisors are more upbeat in their global outlook. 38% bullish and 11% say they're bears, so it's looking better for their global outlook, although they don't look too good at the US market's not looking too good to them. There's more bears than bulls as far as that. The dampened market enthusiasm is relatively recent. 62% of advisors report growing more bearish in recent months. They're bullish on their own prospects. 61% expect to grow this year. Of course, they're going to think that they could do better than the general market, their financial advisors. Advisors' top economic concerns: tariffs and the impact of changing U.S. policies. So right in line with what we talk about every day. Their clients worry about the impact of markets volatility on their nest eggs. So they're worried about retirement. Advisors are diverting more client assets outside the U.S. while decreasing exposure to U.S. equities. They're investing more in non-U.S. equities and non-U.S. currencies. And then we got a little bit more details on this line just without going through the whole PDF. In addition to shifting clients' equity exposure globally, advisors are also redirecting client assets in other ways. 29% are increasing fixed income investments. 28% are investing in more in commodities, 27% in non-US currencies, 37% are increasing cash holdings as far as the US dollar. And interesting, when we go back to the chart of the DXY, which measures the US dollar compared to a basket of other currencies, we've seen that if it pulls up, which one is it pulling up on? XY. We've seen that today, although in this longer chart, and it's right there on that line. On the longer chart, it's down, but on today, it's up, and it's slightly green on the day. So this is where we're at, y'all. This is kind of the up-to-date I got on what's going on. It's mainly driven around, well, it was tariff negotiations, U.S. and China trade, European Union and U.S. trade. So how all that goes, the impact of tariffs and the inflation, what the Fed does as far as cutting rates, which, let's see what that's looking like real quick on the CME Fed Watch tool. All right, so slightly more expect a rate cut on June's meeting, but remember September's the meeting to watch. Looks about the same as yesterday. What about the end of the year? Yeah, so not too much changing as far as people's expectations for probabilities of a rate cut. But with everything going on, with the main look now isn't probably going to be the data anymore, and watch the data start getting bad, but there's like a new woman in a red dress that everybody's going to like start looking at, and a new shiny toy for everybody to Not calling women a toy. I'm just saying like something that distracts everybody from the data that's going to be coming in. It's going to be this war. It's going to be Trump and the U.S. response to this war. Other trading partners that we're trying to negotiate with, and how they perceive the US in this stance, and if they pick a side in the war, and how all of that happens, because now World War III is the concern and a lot of people are uncertain. So I'll keep on covering this. Hope your weekend's great, everybody, and I'll be back next time. Have a good one.